address the listing of the day. Sanjay Nayak, MD and CEO of Tejas Networks, now joins us. Sanjay, good morning. Good to have you on the show. So 1% higher from issue price. Now that you have listed, maybe you could give us some more details on the kind of growth that we can expect from you. Because last 4 years, the last 2 years have been good for you in terms of revenue growth. What kind of CAGR can the investors expect over the next 3 or 4 years?
First of all, I mean, it's a great occasion for the company and all the stakeholders so far, so I must congratulate all of them and really delighted to be here to be listed as one of the first tech product companies from India. Coming back to your question, yes, we've had a pretty decent growth rate over the last 4 years, growing at about CAGR of about 24% and bottom line of about 40%. If you think of the industry that we are in, the data demand in the world is growing, including in India, and the opportunity for us for growth is clearly there. It is for us to continue to execute as we have done in the past, and we do see opportunities to continue to expand on terms of the top line. And as a product company, we still see operating leverage coming into picture. So we are confident that as our revenues continue to scale up, we'll see some improvements in the bottom line as well.
Sanjay, I believe a large chunk of your revenue, of course, was coming in from government orders with the BharatNet project, etc. Was that sort of a one-time? How do you see the revenue pie between private sector and government shaping up for this year? And if you could give us margins on both sides of the business as well.
So first of all, by the way, the good news is that our business, we have been able to blend it quite comfortably between the government, private, as well as the international. And the three together, we have seen a consistency in terms of our margin stability as well as growth. So the nature of the business that we are in, there could be orders which are a bit lumpy. So it could be possible that in one particular quarter we'll have a larger order from a government entity or a private operator for that matter, or an international customer. But on an overall basis, if I look at an annualized basis, we do see consistency in growth. So I would not say that there's a particular order or a particular customer who has given us a boost, because the macro trends in our industry are much healthier. If you really see just the way the data is growing, both the government spending is in for a next 5 to 7 year cycle, and similarly in India, the private operators are just about to start spending much more capital expenditure on the data side of things. So I don't think that's a one-off situation for us. It's a consistent opportunity that we see in growth, not just in India but around the world. So I would say that's something that's going to improve. And as far as the margin is concerned, we don't see any particular size or side of the business, whether it's India private or India government or international, having any adverse margin impact. So as we see our quarter results and performance going forward, we would see that we've been able to blend all of that quite reasonably in our business, and we'll continue to see a consistency in those aspects as well.
Sanjay, your working capital was at 143 days as of FY17. With 300 crores of the fund raised used to bring down your working capital, what would it stand at FY18? And going ahead on a sustainable basis, what should be the working capital days average?
So the good news is, if you see our past trend over the last 3 years, our working capital has significantly come down as a percentage of revenues, and as you rightly pointed out, our receivable days are at around 150. We have seen a significant improvement, and the trend line on that has been very positive. So about 2 years back, our receivable days were much higher at around 250 days. Now it's around 140. So directionally, that's the way we are going. And on a steady state basis, we should be able to, which we'll probably reach in about 4 quarters from now, we should be able to see around 90 days of working capital on a steady state basis, which is pretty much in line with our global industry, and we don't see any reason why we shouldn't be able to get there. So I would say that's something which we have seen significant performance improvement in the past and will continue to happen as we go forward as well.
You mentioned your CAGR last couple of years has been around 34%. Is that the rate at which you'll sustain now? Lower, higher?
So it's of course very hard to predict the future. And the only thing I can say is that the opportunity for growth is clearly there. Around the world, data consumption is increasing. In India, while the capex of telcos is under a little bit of a stress, but the part of their capex which will go into optical equipment, which is building high capacity data networks, is going to increase. And within that, the fiberization of cell towers, which is where we only have 20% penetration, is going to increase even further. And that's really where a lot of our sweet spot of the business is in terms of metro. So I would say that the macro situation for our business is clearly available for growth. Our competition, we have been able to sustain all the global competitors in a way which is very competitive. In India, we are among the top, and globally, we are also ranked among the 6th in the world. So I think as long as we continue to execute, the growth opportunity is there, and we will see not just top-line growth, but with operating leverage coming in as a technology product company, we would see some benefits of that accruing as we have seen in the past few years. So I would say the trend seems healthy in the past, and the opportunity is available, and it's for us to continue to execute in the right direction.
Okay, all right, Sanjay.